I will be going to start with lecture number 2. Lecture 2. Reading 38. And lecture number 2. And the topic which we are doing is working capital management. So friends, in the last lecture, that is in lecture number 1, I have not covered any learning outcome. There are 7 learning outcomes, but I have not covered any of them. I have just told you the intro part, that what is the meaning of working capital, why the funds are required, what are the reasons of fund, all that basic concepts and the introductory concepts I have given you in the last lecture, number 1. Now in today's lecture, I will be starting with your learning outcome number A, and I will be covering learning outcome A, that is what are the different sources of liquidity. What is the meaning of primary source and secondary source? And what are the factors? What are the factors which affect the liquidity position of an entity? So this 2 or 3 aspects we will be covering in lecture number 2 and 3. It means in learning outcome A, I will be taking lecture 2 and 3 very small 10 minute, 5 minute lectures, because these are totally different aspects. That what are different sources of finance, what are the different sources of liquidity of a company, short term, that is primary and secondary. Now what is the meaning of primary? When I say primary, please open your registers. Please start writing down something. What is the meaning of primary? When I say primary is the main source. For example, you have already done CFA or you are doing CFA, along with that you will be doing FRM after some period. So I will say CFA is your primary source of income, and FRM, risk management, financial risk, that course is secondary one. It means primary means, for example, for an entity there are 2 types of objectives in an objective clause. In an object clause, primary object, that we will be doing this, we will be doing this, we will be doing this, we will be doing this. What can be a primary object of a Polo tires? Can you tell me? A Polo tires primary object will be to manufacture and to sell tires. That can be a primary object. But along with that, they can also have some ancillary or secondary objects also, which are not their main objects. Primary object is through their operating activities. I repeat. So there can be different types of activities which an entity take. Operating activity, investing activity, financial activity, primary activity, secondary activities. So I am talking of primary activities. So my dear friend, in today's lecture number 2, I will be covering with learning outcome A. And in that I will be telling you the sources of liquidity, or what is the meaning of liquidity. Firstly, I want to tell you what is the meaning of liquidity. Can any one of you can tell me that what I mean by liquidity? What is liquidity? When I say liquidity, it means converting into cash. That is converting something into cash quickly. How quickly we are converting into cash? How quickly my cash is being generated? That is named as liquidity. As the name indicates, liquid. It means I can easily get cash from that. Some assets can be liquid, some assets can be illiquid. For example, if I want to sell a land is illiquid. It will take some time period to sell, because I have to find out the buyer and the deal will be stuck, and then only I can sell it. It is illiquid. But when I say liquid, I can say I have a stock. I can sell it now, or I have cash in my hand, or bank balance, or marketable securities. These are cash and cash equivalents. These are liquid. So liquid means how quickly we can convert into cash. So liquidity is availability of cash, how quickly, and availability of cash can be possible with the help of two sources. One is primary and second is secondary. Primary is the main source. Primary is through operating activities. Primary is through your main business. And secondary is not your main source, because in urgency, because in emergency, because you require something, because there is primary sources not working properly, then only you will go to secondary source. For example, in case of Kingfisher Airlines, if cash is coming by the help of by the trips from those aeroplanes, that is operating activity. But because cash is not coming, that liquidity position, there is a problem in case of Kingfisher Airline. So that they have gone for secondary source. That is they want to restructure their debt. And in actual, they have restructured their debt. For example, now what is the meaning of restructuring of debt? When I say restructuring of debt, I mean that supposedly they have borrowed a loan from bankers, and Kingfisher Airline has to pay principal as well as interest, but they are not in a position to pay interest. So they are requesting their bankers that we are not able to pay interest. Either give us the time period, more time period, or just waive off some part of interest, or convert some part of debt into equity. I said three things: either waive off my interest, or give us a time interval to pay the new interest, or convert debt into equity. So all this is named as secondary or restructuring of debt. But may I tell you that this secondary source of liquidity is not considered as a positive sign for any entity. Because liquidity should come from the primary source, then only I will say this company is a positive feature. So let's write down something on this. So let's write down something. These ideas we will be writing down. Today will be lecture number 2. Lecture number 2, reading number 38. I will be covering with learning outcome A. Describe primary and secondary sources of liquidity. So today we will be discussing with this learning outcome A and factors that influence liquidity position. And what are those factors which influence your liquidity position? And before writing down, I have written one quotation: do not stop until you are proud of yourself. Keep going, keep going, keep going, keep doing, keep studying until you are proud of yourself. Don't stop. So please write the first point. Do not stop. Please write down first point in your register. What is the meaning of liquidity? Highly testable area. What I mean by liquidity, it implies how firms in normal generate cash. It implies how firms in normal generate cash. That is how quickly you can convert into cash. That is named as liquidity. How quickly you can generate into cash, or it implies how firms in normal generate cash. That something is liquidity. And there are two sources which I have just told you. Please write down. You have to write down. Don't try to be over smart. Please write down. This is the last topic, last reading of corporate finance. There are two sources of liquidity. One is primary source, the main source, and the second is secondary source. Secondary source. When I say main source, what I mean? Cash sales. What I mean? Cash collected from accounts receivable. Cash collected from accounts receivable. Cash credit, line of credit, bank overdraft. All these are primary source of liquidity. So please prepare a flowchart like this. There are two sources of liquidity. One is primary source of liquidity and second is secondary source of liquidity. And when I say primary source, I mean the main source. It means with the help of that source, we can easily judge whether the company is doing good or not. That is primary source. For example, I have written 3 examples. Example number 1. Cash sales from normal operations. Cash sales from normal operations. Cash received from accounts receivables. cash received from accounts receivables. It means from debtors. It means we have sold the goods on credit and we are getting that from our customers after that credit period. That is cash received from accounts receivables. And third is line of credit. Supposing we require urgent cash and we are getting cash credit facility or bank overdraft from bankers. That is named as line of credit. So all these three sources are primary source of liquidity. And what about secondary source? I have written two examples. Sale of assets. For liquidity, you are selling your asset. That is not considered as a good source. So an entity should mainly depend upon primary source or should get the liquidity from primary source. And in case of occasional cases, they can go for secondary. So sale of assets and restructuring your debt. For example, in Kingfisher Airlines, they did restructuring of debt. That is by converting their interest, either waiving off their interest or getting the longer time interval for interest or converting interest or debt into equity. Now, the third point is very, very important, highly testable area. In normal operations, companies should meet their liquidity requirements from primary. But in case things are not well, or in special or emergency scenarios, my dear friend, you have to write down. In emergency or in special scenarios, secondary sources of liquidity can also be availed. In case of this, secondary sources can also be availed. So this is for today's lecture number 2. I have not covered the full LOS in A in this lecture number 2. Learning outcome A consists of different points. The first point is what are the different sources of liquidity, primary and secondary. And second point I will be covering in third lecture. That is, what are the factors which influence? What are the factors which influence the liquidity? So that I will be covering in next lecture number 3. Hope you have enjoyed this lecture. Be happy, be jolly, be cheerful. Great morning, my dear friends. Bhupesh Anand this side again. And today we will be starting with lecture number 3. And learning outcome number A will be there because we have to complete firstly learning outcome A. In the last lecture number 2, that is of only 11 to 12 minutes, I have just discussed that what are the sources of liquidity, and there are two types of sources. One is primary source and second is secondary source. When I say primary, it means it relates with the operating activities, and cash received from debtors or accounts receivable is a primary source of liquidity. Cash sales is a primary source of liquidity. Getting line of cash credit from bankers or bank overdraft facility is a primary source of liquidity. An entity should firstly depend upon the primary source, and we can find out whether an entity is healthy or not. It is only on depending upon the primary source. So whether that is company's entity is healthy or unhealthy, we can easily distinguish that whether the main source of liquidity is from primary or whether it is from secondary. Now the point is, why or what are the factors which can affect the primary source, or what are the factors which can affect the liquidity position of an entity? What are those factors which depend, or what are those factors which depend that whether that CFA aspirant will clear this time or not? It depends upon so many factors. How much hard work he has put, how much actually he is giving the time, how much he is devoting, how much test series he has done, how much lectures he has attended. It depends upon so many factors that whether that person, that individual will clear his exam this time or not. On the same basis, there are two factors I can say which can affect, those factors which can affect the liquidity position of an entity. So today's lecture number 3 will be on those. What are those factors? One factor is inflow and second factor is outflow. So I will be discussing with those two factors, which two factors will affect liquidity of an entity. So my dear friends, please take out your calculator. There is no need for calculator today. Please take out your registers and write down lecture number 3. I am writing down lecture number 3. lecture 3, and that is again on learning outcome, learning outcome, learning outcome A. So I will be covering with learning outcome A. The remaining part, it means in learning outcome A there are two parts. The one is the sources of liquidity and second is the factors influencing those liquidity. Now there are two factors. One is primary and second is secondary sources. Now if I say primary, I mean cash received from accounts receivable. Suppose an entity, suppose this company, this is a company named as ABC and selling goods to its customers, selling goods to customers on credit, selling goods to customers on credit. Let the credit period be 60 days. This company, this entity ABC is granting a credit of 60 days to their customers. But these customers, they are not paying at accurately 60 days. Rather, they are paying at 70 days, 80 days, 90 days. It means they are lagging their payment. It means they are taking more time to pay. So in case the cash is coming in from accounts receivable, that is not coming in. So I will say this is drag. They are dragging my receivables. They are dragging my cash. So this concept, because this entity will not get that cash that from the account receivable on the 60th day. Rather, they are paying on 80 days, 70 days, 60, 65 days. It means they are drag on inflows, my inflows, which I am supposed to receive on 60th day is being dragged on, is being delayed by my customers. So due to that, my liquidity position will matter. My liquidity position will be affected. So we are discussing what are those factors which can affect your liquidity position. So this factor is the most important factor, that my inflows will be dragged, will be delayed. So I will not be getting cash and I can face a liquidity position problem. So this can be main reason. So I will be giving you one word, drag in, pull out. So this word you have to remember, depot. It means drag. Drag is something which is in relation to inflows. And pull is something which is in relation to outflows. So I have to tell you what is the meaning of pull on outflows and drag in inflows. I have just given you an example of how we can be, what I mean by drag in inflows. Now what is pull on outflows? Now what is the meaning of pull on outflows? For example, I am just again taking the example of that entity ABC. Now this entity has purchased something from their suppliers, inventory from the suppliers. This company ABC has purchased own credit from suppliers, and the normal credit period which is being allowed by this supplier is 30 days to this entity. Normally from last 1 year, last 12 months, they are giving us a credit of 30 days. We are an entity. I am talking from entity point of view. I am talking for ABC, that what are the factors which can affect the liquidity problem or liquidity position of ABC. I have told you that first factor is that customers are delaying your payment. I am not getting inflow at that particular time. So drag means in relation to inflow. Now, second factor which I want to tell you is pull on outflows. That we are supposed to pay after 30th day, but these suppliers, they are demanding that they want payment earlier. They require the payment earlier than 30 days, and it means we are forced to pay after 15 days or 16 days or 20th day. It means what we are supposed to pay on 30th day, we have to pay on earlier. So it means my outflow will be restricted and there will be a pull on my outflow. You are getting my point? Pull is always in relation to outflow and drag is always in relation to inflow. So these 2 points you have to remember in your mind. Drag in is related with inflows and pull out is related with outflows. So please note down 1 or 2 slides I have just prepared for you. Great morning. Lecture 3. Learning outcome A. Working capital management. Factors that influence liquidity position of an entity. Factors that influence liquidity position of an entity. factors that influence liquidity position of an entity. So the first factor is, following can be the two factors. I have divided into two parts which can influence. This is one word, influence. This is one word, influence liquidity position. One is drag on liquidity, that is inflows. Second is pull on liquidity, that is outflows. Now drag on liquidity is always to be read with inflows, in relation to inflows, and pull on liquidity is always to be read in relation to outflows. So my dear friend, let's write point number 2. The word which I have given to you is DIPO, D-I-P-O, D-I-P-O. Drag in. Drag is always in relation to inflows and pull is always in relation to outflows. So drag all inflows, pull all outflows. Drag all inflows means all those items, all those transactions through which I am supposed, as an entity, I am supposed to get the cash, but I am not getting that. So that something is named as drag in, and the best example is delay in the payments by accounts receivable. Those people, those debtors, they are delaying, they are delaying my payment. I have to receive the cash, but they are not paying it. Pull on outflows. Pull is always in relation to outflows, and drag is always in relation to cash inflows. And this, and it means they have demanded. It implies when accounts payable, that is suppliers, accounts payable have demanded payments earlier. When accounts payable have demanded me payments earlier, that is named as pull on outflows. So like this, we have covered learning outcome A in 3 lectures, in second lecture and third lecture. First lecture was in relation to introduction of working capital management. Hope you have enjoyed the lecture. Be happy, be jolly. Bhupesh, and this side, I am a chartered accountant. I am a company secretary, and I will be taking the lecture number 4, CFA level 1, corporate finance, reading 38, working capital management, learning outcome B, and lecture number 4. So today's lecture, today's learning outcome number B, that what are the liquidity measures? How to evaluate what are the benchmarks, how to check the liquidity measures, what are the liquidity tools, what are the ratios involved in that, and how to compare it with peer companies, whether firm A is doing good or firm B is doing good. So today's lecture will be lecture number 4. I repeat myself, Bhupesh Anand, going to start with lecture number 4, learning outcome number B. And the name or the heading of learning outcome B is what are different liquidity measures? What are the different tools of liquidity with the help of which we can evaluate? So for evaluating liquidity measures and then to compare it with peer companies, I want to just give you an example. Supposingly Mr. Ramlal is suffering with fever and he goes to his doctor. Now what doctor will do? Firstly, what doctor will do? He will not directly give medicine. Firstly, he will analyze, he will use some tools, he will use some measures, and on the basis of that, he will find out what type of disease Mr. Ramlal is suffering with. And then only he can, give the comments or interpret that what Ramlal is suffering with. The point is, similarly, as a corporate finance team member, as you want to analyze, you want to measure the liquidity of a company. So you have to calculate some ratios in that. So we will be calculating 5 to 6 ratios in this chapter, in this learning outcome B. Highly testable area in June and December, CFA level 1. I want to tell you the basic real crux of this learning outcome B. What are the liquidity? What is the meaning of liquidity? We have discussed in lecture number 3. I have told you what are the sources. Now I want to tell you that if I will give you a firm A information, some numbers, and firm B some information, then how to calculate whether which company is doing good, which company has a high liquidity and which company has a low liquidity. What are the symptoms? So in order to calculate the symptoms, I will tell you something about the ratios. So please take out your registers. Please take out your register, my dear friend. Bhupesh on this side. So you have to write down something. I prepared some handwritten slide for you on the basis of CFA level 1 curriculum. So I have prepared some slides. So let's start with that. I want to estimate liquidity of a company, let it be West side. I want to calculate liquidity of a company, let it be Wills. I want to calculate the liquidity of ITC. I want to find out the liquidity of Apollo Tires. I can estimate liquidity of any entity, whether profit making, whether non-profit making, whether a social club, whether a private limited, whether a public limited, it hardly matters. The tools will have their long lasting effect. Now what are those tools? I will calculate blood pressure. I will calculate sugar level. I will calculate temperature. I will use thermometer, and I will use different types of apparatus. As a doctor uses different types of apparatus and find out ECG, blood pressure, cholesterol level, temperature and all that. Similarly, as a CFA, as a corporate finance team, we will be using some ratios. Let it be these ratios. The first ratio I will be telling you is named as current ratio. Very, very important ratio, current ratio. The second ratio which I will be telling you as quick ratio, and the other name of this ratio as per your CFA curriculum is asset test ratio. And the third ratio is cash ratio. So these are the 3 ratios which we will be dealing with. Current ratio, quick ratio or asset test ratio, and third is cash ratio. Mind it, this is the most stricter, very, very strict ratio this is. And one of the loose ratio is this. So we have to use different formula. We will find out the relationship. So current ratio is current assets upon current liabilities. One student is wondering whether he has to write or not. Yes, you have to write down. Please listen to me and then start writing in your register. Reading 38. Liquidity measures. Now, what I mean by current assets, I have already told you in my lecture number 1 or 2. Current assets, inventory, accounts receivable, cash balance, bank balance, cash equivalent, that something is current assets, and current liabilities, accounts payable, outstanding expenses, that is current liability. Now the point is, we have discussed working capital is equal to current assets minus current liabilities. Now if working capital is positive, now when it will be positive? When current assets are more than current liabilities. When current assets are more than current liabilities, then working capital will be positive. And if it is positive, current ratio will be greater than 1. When I say current ratio is greater than 1, it means current assets are more than current liabilities. It means this company has a good liquidity ratio. Liquidity. But if I see in the current assets, supposedly these are the 3 assets. One is inventory, second is account receivable, and third is cash balance. When I say inventory, when I say inventory, it is a stock level which I have, Now, in order to convert inventory, firstly we have to process this inventory, then we have to sell this inventory, and then cash will be converted. In quick ratio, as per CFA curriculum, we will be subtracting inventory from current assets upon current liabilities. It means in current ratio and quick ratio, there will be a change in the formula. In current ratio, I will be doing current assets upon current liabilities, very, very simple. In quick ratio, I will be subtracting inventory from current assets. So current assets minus inventory upon current liabilities. But in cash ratio, the intent is more stricter because I will be using the formula current assets minus inventory minus accounts receivable upon current liabilities. Now the logic is why we are subtracting account receivable also in cash ratio. My dear friend, when I say account receivable, it means I have sold the goods in credit to those customers. Firstly, I have converted inventory and process inventory to finished goods. Now that finished goods are being sold to customers on credit. Now after a credit period, they will pay us cash. It means when I say cash ratio, there are two items in which cash cannot be equally converted. It will take some time. And it depends upon so many contingencies. So being stricter, in cash ratio, what I will be doing, current assets minus stock and minus cash. It means two, minus inventory and minus account receivable. So balancing figure, that is current assets minus inventory minus account receivable divided by current liabilities. That something is named as cash ratio. So for an entity, in order to find out whether the entity has a liquidity, proper liquidity or not, we will estimate some tools, and within that tools, we will calculate ratios. I have told you 3 ratios. I will be telling you 3 to 4 more ratios, and with the help of those ratios, we can judge the liquidity of an entity. So first ratio is current ratio, second is quick ratio, which is also named as asset test ratio, and third is cash ratio. And the formula is very simple. Current assets upon current liabilities. Second is current assets minus inventory upon current liabilities. Third is current assets minus inventory minus accounts receivables upon current liabilities. Now, my dear friend, I want to tell you some 2 more ratios today in today's lecture. Otherwise, we will be doing some, 5 to 6 ratios in this learning outcome number B, which relates to liquidity measures. Which relates to liquidity measures. First is current ratio. Second is quick ratio. Third is cash ratio. Fourth is, I will be telling you inventory turnover ratio. Fifth is debtor turnover ratio. Sixth is creditors turnover ratio. And seventh is, I will be telling you operating cycle, total operating cycle, and cash operating cycle. It means with the help of these 7-8 ratios, I can easily find out whether this company has a liquidity, has a possible liquidity or not. So let's start with some handwritten slides I have prepared for you. I have taken some help of some case studies. So it will be very kind information or kind request to you that please take out your registers. Please sit straight. I have already prepared so many good slides for you so that the concepts will be better clear. So let us start with lecture number 4. Great morning. Lecture number 4, working capital, reading 38, and the learning outcome B is compare companies' liquidity measures with peer companies. So before comparing it, at least I should know what are those liquidity measures. When I say liquidity measures, those are nothing but ratios. So first point is liquidity measures. In order to measure, it means those tools. Just I have given the example of a doctor. Just like a doctor uses different types of tools, different types of instruments in order to check, in order to diagnose the disease. On the same basis, CFA, a financial analyst, will use different types of measures, different types of tools in order to diagnose what the problem is. So liquidity measures. In order to measure the liquidity, following ratios or liquidity ratios or measures are being calculated. And I have prepared a drum for you. 6 or 7 ratios are there. But first set number 1 is, I will be telling you 3 ratios. Current ratio, quick ratio, and cash ratio. So please write in the formula, my dear sir. Current ratio is equal to current assets upon current liabilities. Current assets upon current liabilities. And when I say asset test ratio, or I can say quick ratio, I will subtract inventory, and I have told you the logic why I will deduct inventory from current assets. Because it can take some more time in order to convert into cash. because it depends upon so many contingencies. So as per CFA level number 1 curriculum, I will deduct it. So the formula will be quick assets upon quick liabilities, and that is current assets minus inventory upon current liabilities. And the third ratio, which is more stricter, I can say, is cash ratio. So from current asset, we will deduct two items. One is inventory and second is accounts receivable. The customers to whom we have sold the goods on credit upon current liability. And in the third point, I have written quick ratio is stricter than current ratio. But cash ratio is more stricter than quick ratio. So please read or write down point number 2. Quick ratio is relatively more stricter than current ratio. Cash ratio is more stricter than quick ratio. In point number 3, I have just told you that what is the relationship of working capital with the ratios. When I say working capital, it means current assets minus current liabilities. When I say working capital is positive, it means current ratio is greater than 1. So please write down third point and the explanation of third point. And then I am going to start with the most important ratios. That is inventory turnover ratio, that is debtors turnover ratio, that is creditors turnover ratio, that is net operating cycle. So these are the 4 heroes which I am going to start with. In today's lecture number 4, I will be dealing with 2 ratios. It means LOSB is somewhat lengthier. I will be taking one more lecture of 10 to 15 minutes, lecture number 5, for covering average creditors turnover ratio and operating cycle, because in each ratio I have given you so many case studies, because my objective is that it should be, in reality it should be conceptually clear to you. So please my dear friends, let's start with point number 4. We have written 3 slides. Let's start with point number 4. Learning outcome B, inventory turnover ratio. Inventory turnover ratio, as the name indicates, inventory turn, how many times he is turning. Ratio, a measure that in a year, how many times this inventory is being purchased and sold, bought and sold. It means higher or longer, or the higher the number of times this ratio will be, the better it is. More the number of time, higher the number of turnover ratio, better it is. So my dear friend, I want to tell you how quickly my inventory is being sold. If firm A has a high inventory turnover ratio, it implies so many to me. As an analyst, it implies so many things to me. It means the inventory of that firm is quickly being sold. That is more number of times it take a turn. Now, why it is quickly sold? It can have a good quality, it can have a brand value, it can have a discount policy. It means there are so many reasons for higher inventory turnover ratio. So those secondary reasons I can easily evaluate that what are those reasons due to which there can be a higher inventory turnover ratio. You getting a point? So inventory turnover ratio, it implies how quickly the inventory is being sold. Please write down. 4th point, higher the inventory turnover ratio, better it is. Now why it is better? That I will explain you with the help of a case study. Just please, for the writing sake, just note on the figures. I have given you the formula cost of goods sold upon average inventory and how we have calculated this formula. I will give you the logic. There is no need to learn or cram these formulas. I will tell you what is the logic behind that. Just please, firstly, your task is to write down. Higher the inventory turnover ratio, better it is. Following is the formula of calculating inventory turnover ratio. Formula is inventory turnover ratio is equal to cost of goods sold upon average inventory. Now I have given the example, I have taken the example of 2 firms. Why cost of goods sold? That I will be telling you, I will be proving this. So first listen to me, just forget the formula. Just see this case study. I have taken an example of 2 firms, firm A and firm B. Supposingly, you know the formula and you know the crux or you know the concept that how we have calculated why cost of goods sold in the numerator and why average inventory in the denominator. For a second, I can assume this. Just see to me what I want to say. Let the inventory turnover ratio of firm A be 6 times. Firstly, I want to tell you what is the interpretation of time, 6 times, and let the inventory turnover ratio be 12 times in case of firm B. Now, what I mean by times, it means in case of firm A, 6 times in a year, the inventory is being bought and sold. Bought and sold. For example, for a vegetable vendor, he purchases vegetables in the morning and sells in the evening, and on the next day again he purchases and sells, and the next day again he purchases and sells. Inventory turnover ratio of a vegetable vendor will be 365 times. 365 times, because he's purchasing regularly. Every day in the morning he's selling, purchasing, selling, purchasing, selling. At the end of the day there is no vegetables. In the morning again he purchases from the wholesale market. It means higher the inventory turnover ratio, higher the number of times inventory turnover ratio, better it is. So in case I have taken the example of firm A and firm B, let the inventory turnover ratio of firm A be 6 times and let the inventory turnover ratio of firm B be 12 times. So with the help of this, I want to tell you that prima facie, if I say prima facie, I can say on the face of it, I can say firm B is doing good because they are converting their stock and then purchasing, then selling, then buying, then selling. This transaction is 12 times in a year. It means every month. It means every gap of 1 month or a gap of 30 days or a gap of 4 to 4 weeks. They are converting their inventory and again selling it, again buying it, again selling it, again buying it. I can say that the popularity of the product of firm B is quite higher as compared to firm A. Hence, higher the inventory ratio, better it is. Up to this point, I have just told you why inventory turnover ratio higher and better. Now I will tell you how I have derived that formula of cost of goods sold upon average inventory. Please write down, my dear friend. Please write down, my dear friend. It implies firm A sells its inventory in 2 months or 60 days. If I take 1 year as 360 days, generally we take it as 365 days for the calculation sake. I have just assumed 360 days. It also implies that firm B inventory within 1 month. Firm B sells inventory because it is being turned 12 times. In a gap of 12 months, if it is converted, if it is turned 12 times, it means in 1 month they are selling it. So firm B is better than firm A. Firm B is better than firm A. Firm B is better than firm A. So my dear friend, I want to now tell you how we have derived with the formula of cost of goods sold upon average inventory. 2 months or 60 days, 1 month, this. Now within that, how I have calculated 60 days or how I have calculated 2 months. Logic I have told you. Within, with the cross multiplication, we can do that. If in 12 months, 12 times is they have converted. So how much time period one cycle has taken? So I can multiply 1 into 12 upon 12. That comes to 1 month. And if I want to calculate in days, it can be for 365 days. So the formula is there, but there is no need to, because I have told you the logic. There is no need to cram. Just write down how to calculate that number of days or number of months. Average processing time can be calculated as follows. Average processing time can be calculated as follows: 365 days / 12 months upon inventory turnover ratio. Or you can directly calculate with the help of cross multiplication. Also, there is no need to learn this formula. I have just prepared for you. Now, the point is, for example, 6 times for firm A. In 12 months, it is in 6 times. So for 1 time, 1 cycle, 12 into 1 upon 6, that comes to 2 months. Or I can learn the formula. The 6 is nothing but inventory turnover ratio, 365 upon inventory turnover ratio, or 12 upon 3 upon inventory turnover ratio. But there is no need to learn or cram it. I have told you the formula. I have told you the logic. Now the point is how we have calculated cost of goods sold in the numerator and how we have calculated average inventory in the denominator. I want to tell you, please listen to me. Please sit properly. Please don't sit lean, sit straight. Case study number 1. Now for that, for explaining that formula, I want to take a help of case study number one. Suppose there are two female garment retail outlets, and there is a specialty, in case of brand, in case of, for example, you want to purchase a Van Heusen shirt or a Louis Philippe. In that case, so supposedly they have the huge brands, they will be having limited number of shirts with limited colors. If you want to buy it, you can, otherwise just leave it. But if you go in an unbranded shop, they will be having huge number of shirts. And out of those huge number, you can purchase any one. But in case of branded showroom or a branded shop, you have noticed this. Whether you have noticed this, that they have limited number of varieties of limited number of varieties of the stock, and out of that only you have to purchase, and you have to pay more value, more amount, because they have the brand value. So I have taken the example of West Side, a Tata venture for female garments, and a normal local stall. So I am comparing two things. A normal local stall who has to keep more types of varieties, and a West Side showroom who has to keep very less variety of that outlet variety of garments. So case study number one, please, whether you are writing now, please write down, my dear friend. Suppose there are two female garments retail outlets. Let it be, one will be in West Side and second be local stall. So please, you have to prepare this table. One is West Side and second is local stall. You have heard of West Side? Suppose quantity sold by West Side is 1000 units, and similar is the quantity sold in a year by that local stall. Because I want to tell you something, so that's why I have taken same figure. It can be a hypothetical example also. But just now I have told you that in a branded shop, the number of varieties lesser as compared to other unbranded. So I have assumed average quantity stored at any point of time, on any day, that is 100 units. And local stall 500 units, because they keep unbranded things, so they have to have more variety of goods. So this is logical. 1000 units are being sold by West Side and 100 units are being kept as stock, and local stall 1000 units are being sold and 500 units are in the average quantity. So if I just don't know the formula, just I want to tell you, I want to ask you that number of times able to rotate, how many number of times West Side able to rotate, because he's keeping only 10, West Side is only keeping the average stock of 100 units. It means once those 100 units will be finished, West Side will purchase new 100 units. Once those will be finished, West Side will be purchasing new 100 units. Once those will be finished, West Side will be purchasing more new 100 units. Once they will be finished, again 100 units. You are getting my point? So they will be purchasing after ending this 100 again. So they will go for 10 times in a year. In a year, they will purchase and sell 10 times that inventory. But a local stall, if you see a local stall, they will only purchase 2 times, because every time they have to at least keep 500 units in a stock. So prima facie, if you are not aware of the formula, just tell me how you have calculated 10 times. That is quantity sold upon average quantity in stock. That is 1000 units I have sold upon average quantity in the stock is 100 units. That comes to 10 times. So now with the help of this relationship, quantity sold upon quantity stock, quantity sold upon quantity stored, I will be telling you the formula. Now the point is, as per the mathematics, if we multiply with the same number in the numerator and the denominator, the net result will be same. Because I want to calculate in dollars, in rupees, in amount. So it is not the quantity, I have to find out the amount. So if I multiply numerator with the cost and denominator with the cost, can I do this? Yes, I can do this. Because net result will same. Because as per the mathematics, numerator and denominator will remain same. So quantity sold into cost upon average quantity stored into cost, numerator will become cost of goods sold. Cost of goods sold. So I am deriving the formula for you. And denominator, it will be average value of inventory stored. Average cost, average value of inventory sold. So the formula becomes cost of goods sold upon average inventory stored. Cost of goods sold upon average inventory sold. So this is a formula for calculating inventory turnover ratio. My dear friend, I want to again tell you one more thing, and for that I am taking case study number 2. I hope you are writing all these case studies I have prepared by my own hard work, and I want that you should clear in first attempt. So please write down case study number 2. This learning outcome is very important. That's why I'm taking 2 lectures on this. So case study number 2, let a showroom Wills, again a female garment showroom, you might have heard of Wills. Supposingly cost of goods sold is $1,000. Now, I know that you must be aware what is the meaning of cost of goods sold. I have just told you quantity sold into cost upon average quantity sold into cost. The numerator will become cost of goods sold and the denominator will become average quantity, average value of the quantity sold. Now, I am taking the help of COGS and the average stock inventory. Let it be $1,000 and let it be the value be $200. If I use a formula, then I will get 5 times as inventory turnover. It implies in a year, if I take 365 days, in a year, 5 times my inventory is being sold and purchased. My inventory is being sold and purchased. And if I take 12 months, it means in 12 months, 5 times my inventory is being purchased and sold. Now, supposing I am taking in days. Now, what is the meaning of that? That within 73 days, because in 365 days, I did purchase and sell in 5 times. So if I want to ask from you that in how many days that cycle is being completed, in how many days that cycle will again regenerate. In 365 days, if it is 5 times, then in 73 days, one cycle must have been completed. So my dear friend, there is a formula for calculating average processing time also, but there is no need to cram, Just see the logic. If 5 times in 365 days, then one cycle will be 1 into 365 upon 5. So this is the formula. What is the formula? I have given you the formula. I think you must have written that. The formula is, if you want to calculate in days, 365 days. If you want to calculate in months, 12 months divided by 365 days or 12 months divided by average divided by inventory turnover ratio. But there is no need to learn the formula, because I have told you the logic. That if in 365 days 5 times the inventory turnover ratio turns, then what is the period for one time? That comes to 1 into 365 upon 5. And this is the formula. What is the formula? 365 time period, 365 days or 12 months divided by inventory turnover ratio will be average processing time. So supposingly it is 73 days. Now I want to tell you the interpretation of 73 days. What is the intent behind 73 days? What I mean by 73 days? Just listen to me for 1-2 minutes. If you are not listening properly, you will be out of the game. Next 2 minutes are very important. Supposingly, I have started my journey from T0, and it means I have purchased a stock of 200. So I have kept it plus 200. Within 73 days, or at the end of 73rd day, I have sold minus 200, and again I have purchased 200 worth $200 worth of stock. Again, after 73 days, I am selling it. It means on an average, whenever I will see the stock, when I will go in the stores, my average inventory will be equal to $200, and that is equal to 73 days. Because in full year, $1,000 of inventory has been sold. So $1,000 upon $200, that comes to 5. You getting my point? And then this is the logic behind that. Within 73 days, after a gap of 73 days, it can be converted. So I have told you what is the logic behind inventory turnover ratio. Why higher the better? How we have calculated the numbers? What is average processing time? What is the logic behind that? There is no need to learn the formula. Now the next ratio of today's lecture will be the last ratio. Because I have just told you that this learning outcome I will be discussing in 2 lectures, in lecture number 4 and 5. So last 5 minutes of this lecture, listen to me properly and please write down. That ratio is named as debtors turnover ratio. In the next lecture, we'll be discussing with other ratios also, but debtors turnover ratio, as the name indicates, debtors turnover ratio. Debtors turnover. Now, or I can say accounts receivable turnover. Now, what is the meaning of accounts receivable? It means an entity is selling goods on credit to a customers for a credit period. And after lapsing that credit period, after expiry of that credit period, those customers will pay to this entity. Those are named as accounts receivable. And debtors turnover ratio means how many times this debtors are being turned. It means old account receivables expired and new account receivable comes into picture. Then this new expires at a period, then new account receivables comes into picture. Then this expire and a new comes into picture. It means how many new accounts receivable regenerate in a year. When I say literal meaning, this is the literal meaning of debtors turnover ratio. Just write down firstly, then I will explain the concepts. It implies for a corporate finance team. I'm talking of a corporate finance team. It implies for a corporate finance team how quickly a firm able to recover. Very, very important words I have written. How quickly a firm able to recover cash from accounts receivables. That is named as debtors turnover ratio. That how quickly I can get the cash from those customers. Higher, again my dear friends, higher the debtor turnover ratio, better it is. The more number of times it turns in a year, better it is. I will tell you why. Just firstly write down this case study and the formula. Formula is credit sales upon average debtors, and I will tell you how we have derived this formula. Following is the formula for calculating debtors turnover ratio. Credit sales upon average receivables. Credit sales upon average receivables. Again the same logic. Quantity sold upon average debtors. Then I will multiply with selling price both the sides. I will tell you the logic firstly right on this case study. Let there be two firms. Firm A and firm B. Let the sales be $100 for both the firms. And let the account receivable, average account receivable in a year is $5 of firm A and $40 for firm B. It means in case of firm A, only there are $5 average receivables which always remain in the balance sheet. Or these are the debtors, they have to pay to this entity on an average $5. But they did a sale of $100. So it means $100 upon 5. It means if I see prima facie on the face of it, how many times they have converted 20 times and it is 2.5 times. I am not telling you the formula. Don't use the formula. Just use the logic. What is the logic? If I do a sale of 100 and there is an account receivable on an average of $5, then how many times this debtor regenerate? 5. It means 100 upon 5, that comes to 20 times they have converted again. Death, rebirth. A new entity is coming. So it means a higher the debtor turnover ratio, better it is. Why? I will tell you. Please write down. Prima facie firm A is more smarter as compared to firm B, because they are recovering their cash quickly. Their average receivable is very low. It means turnover ratio is high. It means they are giving a lower credit period. Now, why a firm will give a lower credit period? Can you tell me? Why? Why a firm will give a lower credit period? Because of popularity of the product. Because they are giving some schemes, or because of good management style, or because of, there are so many factors we will discuss. Just write down this case study for debtors turnover ratio. So debtors turnover ratio, the formula is credit sales upon average receivables. Now I am using the formula, and 20 times for firm A and 2.5 times for firm B. We have just calculated, and now I can calculate, I can calculate average debtor cycle also, or number of days in accounts receivable. Number of days in accounts receivable. 365 days upon debtors turnover ratio. Again, there is no need to learn the formula. I can directly relate and directly calculate this relationship. There is no need to learn the formula. For example, I keep it as 6 months as a ratio, or 6 times, I can say 6 times as a debtors turnover ratio for firm A, and 12 times as a ratio for firm B. Now, what is the meaning of 6 times? It means in a gap, in a 12 months, there is a 6 times turning. I prepare a separate, a clean diagram for you. This is T0 and this is T12. It means 6 times the flag is there. 6 times the flag is there. 6 times the flag is there. Okay. It means old debtors. That is 200. They have paid. So we have received. Then again, we have given the goods on credit. Again, after this 2 months, after 6 times 2 months, because how I have calculated 2 months. For example, if in 12 months my debtors are turning 6 times. Now how many months one time will be there? So 12 into 1 upon 6, that comes to 2 months. So this is the formula for calculating debtor cycle. That is credit sales upon average debtors. So 2 months, 2 months, 2 months, 2 months, 2 months, 2 months. And if debtors turnover ratio is 12 times, then it means 12 times the old debtors are converted and new debtors are generated, old are converted and new are generated. So I have written what I have written. It implies, just write in the formula. There is no need to learn the formula. I have just told you. Again, I am taking the same example. 365 days upon 20 times upon debtors turnover ratio. That means 18.25 days. It means within 18.25 days, old debtors the cash is being realized and the new debtors comes into picture. And in case of firm B, once the goods are sold, they pay the debtors, the customers, they pay after 146 days. It means that there can be lesser popularity of the product of firm B, lesser brand value, the poor management, and all other factors can be there. So with the help of debtors turnover ratio, we can easily measure the liquidity of a company. My dear friend, I have prepared a slide for you. It is humble request. Please write down this. There will be no need to read the CFA curriculum level number 1. So many smaller fonts with so many pages. So in today's lecture, I have just told you what are the liquidity measures. I have told you current ratio, I have told you quick ratio, I have told you cash ratio, I have told you debtors turnover ratio and inventory turnover ratio. There is more ratios to go. But that I am not covering in today's lecture number 4. I will be covering in lecture number 5. That is creditors turnover ratio. That is operating cycles. Hope you have enjoyed this lecture. So I think you must have prepared this timeline, and firm B must have waited for 146 days to achieve annual sales of $100. It means firm A is better. It means firm A has a higher liquidity as compared to firm B. With this, I want